Welcome back to Investing Talk Podcast. Today we are taking a closer look at Texas Instruments. A really foundational name in the semiconductor world, a company that, well, powers so much of our digital lives. And the big question we're tackling in this analysis is pretty straightforward. Is now actually a good time to buy Texas Instruments? The stock's been trading sideways lately, kind of stuck in a narrow band, which makes it tricky for investors, right? Is this just a pause before it takes off, or maybe a sign of something else? We're going to unpack the fundamentals based on our sources and try to figure out what the real story is here. But before we dive in, just a quick reminder, please subscribe, like, and maybe drop a comment on this segment. And yeah, if there's a specific company you'd like us to look into for a future analysis, definitely let us know in comments below. We always appreciate the suggestions.
Absolutely. And with Texas Instruments, it's an interesting mix. You've got this real stability, this commitment to returning capital to shareholders, but it's mixed with that unavoidable semiconductor cycle volatility. So we'll break down their well-known financial strength, why their business model is considered so tough, and importantly, look at a couple of key catalysts coming up actually this month, October 2025, that could, shake the stock out of this current pattern.
Okay, let's get into it. Starting with what makes them stand out, the competitive edge people often call the analog moat.
Yeah, it's fascinating. Texas Instruments really shines in the, let's say, less flashy but absolutely vital parts of tech. Their stronghold is analog semiconductors.
Analog chips, so not the super fast processors.
Exactly. Think of these as the essential plumbing. They handle things like power management, temperature sensing, converting signals from real world to digital. Basically, no industrial equipment, no car, no communication system works without them.
Right, the hidden infrastructure. So why does focusing on that niche make them so resilient?
Well, it creates tremendous customer stickiness. Unlike, say, digital chips that might get swapped out every year or two, analog designs can have product lives spanning decades. So once a big industrial or auto company designs a TI analog chip into their product, the cost and hassle of switching to someone else, it's huge.
Ah, okay. So that translates into stable business.
Definitely. Long-term contracts, predictable revenue, and importantly, pricing power.
And I know they're also pretty committed to making their own chips, right? Not just relying on foundries like TSMC or others.
Absolutely. That's a key part of their strategy. They're heavily investing in their own 300-millimeter wafer fabrication plants. This does two things. It gives them scale, which helps keep their production costs low, probably lower than most competitors. And critically, it gives them control over their supply chain and their own technology roadmap. It's a big strategic advantage, a real barrier for others trying to compete in analog.
That makes sense as a long-term strength. But we do have to acknowledge, even strong companies feel the market cycles. Our sources show that full year 2024 revenue dipped, right? Came in at $15.64 billion.
Yeah, that was down about 10.7% from 2023. That definitely reflected the broader semiconductor inventory correction and, softer demand in some end markets. It happens.
But here's the interesting part. Even with that dip.
Exactly. Look at their profitability despite that downturn. That really shows their operational strength. Historically, their gross margin is consistently above 60%.
60% gross margin is huge.
It is. And even now, with the recent slowdown, their trailing 12-month or TTM net income is still sitting at $5.02 billion. That works out to a TTM net margin of around 30%.
Wow. Maintaining a 30% net margin when the whole sector is struggling with inventory? That's pretty impressive. What does that kind of cash generation mean for their balance sheet health?
It basically turns it into what people rightly call a financial fortress. I mean, look at their liquidity numbers. The quick ratio is 3.24. The current ratio is 5.26.
Okay, maybe break that down for us. A quick ratio of 3.24. What does that really tell an investor?
It means they have more than 3 times the easily accessible assets like cash and receivables compared to their immediate short-term debts. They're not just solvent, they're swimming in cash. Both those ratios are way, way above the industry average. It signals incredible financial safety.
And it gives them options, presumably.
Exactly. Options to weather storms, invest, or seize opportunities without being stressed financially.
And what about debt? Is leverage a concern?
Not really. It's very moderate. Their debt-to-equity ratio is just 0.86, and their interest coverage, how easily their operating income covers interest payments, is super robust at 11.45.
So they're not really slaves to their lenders?
Not at all, which, importantly, lets them keep funding those huge investments like the new 300-millimeter fabs without putting their financial stability at risk.
Okay, but that brings up a potential issue, doesn't it? Building those giant fabs costs billions.
Yeah.
Is there a significant risk tied to that expansion?
Yes, there is, and it's important not to gloss over it. While having manufacturing control is a great long-term strategy, there's definitely execution risk. These are massive, complex projects.
Right. Billions of dollars.
Billions. So potential delays in ramping up the fabs, technical glitches, cost overruns. These are real risks. And if that demand recovery takes longer than expected,
They could end up with expensive, underused capacity.
precisely, spending huge amounts on capacity they don't quite need yet could definitely hit their short-term efficiency. It's a calculated gamble.
A strategic strength that carries its own risk.
Good point. Okay, let's pivot slightly. How do they use all that financial strength, especially regarding shareholders? That famous dividend streak comes to mind.
Ah, yes, the dividend. That's a huge part of the investment case for many people, especially those focused on income or long-term compounding. Right now, the dividend is $5.44 per share annually. That gives a yield of about 3.03% as of early October 2025. But the headline is the consistency.
The streak, yeah.
They just increased it again, making it the 22nd consecutive year of dividend hikes. 22 years straight. That really says something about management's long-term focus. And didn't they just bump it up recently? Q2 2025.
They did. The quarterly payout went from $1.36 to $1.42 per share. And you look at their cash flow. TTM operating cash flow is around $6.4 billion. Seems like they can easily afford it.
But I sense a but coming.
Well, here's where we need to look a bit closer. If you compare that dividend payout strictly to their current TTM earnings, the net income over the last year, the picture changes. The TTM payout ratio is actually quite high right now. It's running at about 99%.
99%. So almost every single dollar they've earned in the past year went out as dividends.
Essentially, yes, based on trailing earnings.
Doesn't that seem risky? It leaves almost no buffer if earnings don't pick up soon. Why would such a financially conservative company run a payout ratio that high?
That's the key question, isn't it? It signals one thing very clearly. Management sees protecting that 22-year dividend growth streak as a top priority. They're likely leaning on that financial fortress, that strong balance sheet and cash position we talked about, to bridge the gap during this cyclical low.
So they're using cash reserves to keep the streak alive while earnings are temporarily depressed.
That seems to be the strategy. The risk, of course, is if earnings stay weak for longer than expected, that would put immense pressure on future hikes, maybe even the streak itself eventually, although their cash cushion probably buys them quite a bit of time.
Interesting. So investors are kind of betting on that cyclical recovery kicking in relatively soon. If it does, the payout ratio normalizes. If not, things get tight. How does Wall Street view this? The analyst consensus is buy, right?
Yes, institutional confidence seems pretty solid, likely focused on that long-term moat and financial strength. The average analyst price target for the next 12 months is $218.24.
Okay, and the stock is currently trading around $183, $184.
Right, $183.73 as of October 1st. So that average target implies what, about 21.6% upside potential? And you see some pretty bullish calls out there. Bank of America at $208. Goldman Sachs even initiated coverage at $255.
So the pros seem optimistic. Now, given the strong fundamentals but the stock's recent sideways action, let's look at the technical picture. Current price, $183.73. And it's been stuck, you said, between roughly $180 and $190 for the last 3 months.
Yeah, precisely. The floor seems to be right around $179.86. Call it $180 for simplicity. And the ceiling has been capping it near $190.05 or $190.
That kind of consolidation can be telling.
It really can. It means the market's sort of undecided, but it also gives us very clear levels to watch. $180 is key support. A break below that could signal more downside.
But if it holds?
Then the first hurdle is breaking above $190. After that, you've got the psychological $200 level. And beyond $200, the path looks clearer towards that main analyst target zone around $280.
What are the momentum indicators saying? Are they hinting at a breakout soon or just more this sideways grind?
They're mostly suggesting consolidation, really. The stock is trading just a little below its 50-day moving average, which is around $189.61.
Okay.
And also just below its 200-day moving average at $187.01.
So not really weak, but not showing strong upward momentum either, just sort of hovering.
Exactly. And the RSI, the Relative Strength Index, is near the middle ground at 54.75. Not overbought, not oversold. Neutral. And volatility has been moderate, too, around 5.15% over the past 30 days. Put it all together, it looks like quiet accumulation. The market seems to be waiting for some kind of news, some trigger.
Which leads us nicely to catalysts. The technical outlook seems to be a range, maybe $180 to $218 over the next few months, but very dependent on news. What are the big triggers coming up soon?
Well, the most immediate and probably most important one is the Q3 2025 earnings report. That's scheduled for October 21st, 2025.
Okay, just a couple of weeks away. What's the expectation there?
Analysts are really looking for signs that the semiconductor cycle has truly bottomed out. They're hoping to see sequential growth, quarter-over-quarter improvement. If Texas Instruments delivers a solid report and gives positive guidance, that could be the catalyst to break it out of that $190 resistance level.
Makes sense. And there's another date soon after that, relevant for income investors.
Yes, the next ex-dividend date is October 31st, 2025.
Halloween. Easy to remember.
Right. And given that 22-year history of dividend growth, this date often attracts buying interest from income funds or investors wanting to capture that payout. It can sometimes provide a bit of a technical support floor around that time.
Okay, so 2 key dates this month. What about less tangible things? Any market buzz or rumors floating around that could move the stock?
There's always some chatter, you know? Lately, there's been speculation about potential new major partnerships in the automotive sector, especially around chips for electric vehicles, power management systems.
Which would be a big growth area.
Huge. Also, talk about maybe accelerating their U.S. manufacturing plans, perhaps leveraging the CHIPS Act incentives more aggressively. That could mean government grants or tax breaks down the line.
But important to emphasize, these are just rumors at this point, right? Not confirmed news.
Absolutely. Treat them as potential upside surprises, not guaranteed events. There's also the usual background noise about maybe strategic alliances, some M&A chatter, though, that seems less likely for a company this size, or maybe even accelerated share buybacks if cash flow stays really strong.
Got it. Okay, before we pull it all together for a conclusion, let's just quickly revisit the main risks we touched on earlier. We mentioned the fab execution risk.
Yes, that's a big internal one. We also need to remember the external risks. First, the general earnings volatility tied to the semiconductor cycle itself.
Right, they're exposed to the broader economy.
Very much so. If global industrial activity slows down, TI feels it. Second, there are always geopolitical and regulatory risks, particularly concerning trade tensions or regulations in major markets like China or the EU. That could impact their market access or costs.
Okay, good reminders. So let's synthesize all of this. The strong competitive position, the fortress balance sheet, the dividend commitment, but also the high payout ratio, the consolidation, the upcoming catalysts, and the risks. Based purely on the source material, what's the overall investment conclusion?
The analysis points towards a bullish view, maybe an 8.5 out of 10. The current price, around $183, $184, looks like a potentially attractive entry point, especially ahead of that key Q3 earnings report. The fundamentals are just very solid. Strong margins, even in a downturn, incredible balance sheet safety, and a shareholder return program that's clearly a top priority, even if it means stretching the payout ratio in the short term.
Okay, so if someone's looking at this with a shorter time frame, say the next 3 months.
For the short term, it looks quite interesting for positioning ahead of earnings and that ex-dividend date. The technical setup suggests a potential move towards that $200, $218 range if the news is positive. And you have that clear $180 support level to manage risk against.
And for the investor with a much longer horizon, someone looking to compound wealth over years.
For them, Texas Instruments still looks like a core holding. Its dominance in analog, combined with its manufacturing scale, positions it really well for long-term growth as industries electrify and automate further. Plus, you get that reliable, growing dividend income stream.
All right, so before we wrap up, here's something for you, our listeners, to think about this week. It connects that strategic commitment with the current financial reality. We've talked a lot about Texas Instruments' incredible 22-year streak of increasing dividends, a huge signal of discipline and shareholder focus. But right now, that commitment means they're running a trailing payout ratio near 99% of earnings. That's a number that usually makes value investors pretty nervous.
Yeah, and that tension creates a really interesting question for you to consider. How much real safety margin does a company have to keep boosting dividends and fund massive, inherently risky expansion projects, especially if the much-anticipated cyclical recovery in semiconductors takes a bit longer than expected? How do they balance that absolute priority of the dividend streak against the pressures of the market and their own growth ambitions? That's the core dynamic to watch here.